Good evening, wealth builders. I am going to cover, this is your lesson, third lesson. I'm going to cover pips, spreads, volatility, and the trend. All right. And so I know if you've ever been to New York City, you'll see the bull in the financial district. And so that's associated with the New York Stock Exchange. But within the Forex market, we have a bullish and a bearish market. And so a bullish market or a bullish pair, or say a bullish trend, for example, is when the price is going up. All right. And so looking at this on a daily time frame, and I know you guys have never seen this chart before. In the next few lessons, we'll be covering how to read these charts. But basically, essentially, over time since March 20th of this year of 2020, price has been going up, slowly been going up. All right, so that means this is a bullish pair. All right, now if we were to come over here, we can see that it used to be bearish. So bearish when it goes down, bullish when it goes up. So the bulls go up. And when we say bullish, or when somebody says going long, that means that they're putting in a buy. They expect the price to go up, so they're putting in a buy. When things are bearish, they're going to say they're going short. They're putting in a sell. All right. And so if you're not familiar with it, but Forex, you can make money whether the price is going up or going down. All right. And you do that by putting in a buy or a sell. So let's talk about counting pips. So we have this phrase, we say 20 pips a day keeps the bills away. So the goal typically is to catch 20 pips. All right. And what is a pip? So if you ever traveled overseas, if you've traveled to another country, you've had to exchange um, your country's currency for another currency. Okay. And so if I'm going to, since this particular pair is currently bullish, I'm looking for a low point to buy at and then sell it up here. Okay. And so, if I were to actually exchange the euro, which is the base pair, and the American dollar, which isn't. So basically, the way I would read this, for 1 euro at this current price, for 1 euro, I would get 1.21 cents of American dollars. All right. And so I'm on the daily, and price doesn't really change that much from a traveler's point of view. Like it's gone from, 123 and it's down here. So the past 4 days, prices has the value of the American dollar has been essentially, or the value of the euro essentially has dropped. Okay. Because you can get fewer US dollars today than you could 4 days ago. That's essentially how you read it. For for 1 euro, how many American dollars? And this price over here is telling me how many American dollars I can get. Okay. There is a difference in price. There is a ask and there is a bid price. The ask price is the price that you buy it at when you want to put in a buy, and the bid price is the price that you put it in when you're putting in a sell. The difference between those two prices is what we call the spread. Now, in the previous session, we talked about Forex sessions, and I showed you when particular pairs were extremely volatile, meaning price was moving and more than likely the spread was short, meaning the difference between the ask and bid price was relatively small. And so for AUD, USD, this pair typically trade. Normally, a good spread is about anywhere from 13 to 15 pips away. All right. And so I could zoom in here so you can see these three lines. So this price right here, if I were to put in um, sell, I would be selling it at this particular point. I would be selling the blue line, the bottom line. And if I want to put in a buy, I will be buying it at this top line. All right. And so I don't go into profit. If I'm putting in a buy, and this is, so let me establish. If this is my oh, all right. So this would be my ask price, which is above. And then this could be my bid price, which is below. All right. And so currently this particular in the last, I'm a 5-minute chart. So it looks like it's going bearish. So I would want to put in a sell. I'm expecting price to come down. If I were to sell right now, I would be selling it. I would be purchasing at this price. And I would not, no, I'm sorry. I would be selling at this price. I'll be selling at this price here. And I don't go into profit until price comes below this line. If this were a bullish market, I will put in a buy. And when I buy it, I'm buying at the ask price. All right. So you see these 3 lines. The line in the middle is currently where price is at. And it's typically right between the middle of the ask and bid price. So if we were to track the spread, we would have to deduct the bid from the ask price to figure out how many pips that is. Or you could come over here and use this ruler. And we essentially have 11.4 pips difference. All right. So that means that price will probably be somewhere around here. The active price. All right. This isn't where it's really at, but the prices are pretty small. I make that green. All right. So if I wanted to put in if I'm expecting price to come up, then I could say, oh, price might come down here, come out, break and retest, and go back up. All right. So if I wanted to put in a buy, I would be buying it at 1.21800. All right. If I thought price was going to go down, I would go here, break and retest, and then right there. All right. So I would actually be selling it at the ask price. So that means that, I'm sorry, selling it at the bid price. So when price comes beneath here, I'll be in profit. So hopefully that makes sense. All right. And so how do we count the pips? So this 0, the pip isn't always in the same place for every currency. Right now, this big 1, all right, so we got 1, 2, 3, 4 digits to the right of the decimal is the pip. And this number that you see that is smaller but lifted up is called the pipette, all right? You want to count the pip, all right? And so if we deduct 1.21800, which is the ask, from 1.21686, which is the bid, we determined that it had 11 point, let's see, got 4 makes it the 9. You got 1, 10. All right, so that's our spread. The difference between the ask and bid price is 11.4 pip spread. The 11 is the pip, the 0.4 is the pipette. All right. And so basically we count it as ones, tens, 100s. All right. So if we make this really big, 1.21800. All right. So let's underline this. This, let me see. This right here, that is the pip. All right. This is the tens right here. And this is the 100s. All right. And so if we wanted to catch 20 pips going down, we would want to put in a sell, and we would want to get it down to 1.600. Because like I said, we can make money no matter what direction the price is going. All right. So catching 20 pips for this particular pair means price would go from 1.218 down to 1.216, catching 20 pips. So this is the ones, the tens, and the 100s. If we wanted to catch, say, 40 pips going up, because that can absolutely happen, that would then be 1.22200. Yeah. Believe that my math is right. Okay. All right. So that's 40. So we deduct 2 from this particular lane or add 4. So 40, catching 40 pips, putting in a buy, or catching 20 pips, putting in a sell. All right. That's how you count the pips. And so the pip can be in different places. Like for gold, for example, gold is an indice. All right. And it's one of the currency pairs, but you're basically trading gold against the American dollar. All right. And so basically for every one spot of gold, I would get $1,831 and basically round it up to 77 cents. It's a pretty nice bang for the buck, right? But the pip for the gold pair, we call it just gold for short, is actually right here. It's 2 decimals over to the right of it's 2 decimals over to the right. All right, and the pip bet is the third one over. So if I wanted to catch 20 pips in gold, and price is currently, say I enter at 1,480 current price. If I wanted to catch 20 pips, going up, it would have to be 1840.02. That is 20 pips for a buy and profit. If I wanted to catch 200, I'm sorry, that's wrong. It needs to be the 20 here. At 20 pips for a buy. If I wanted to catch 200 pips for a sell, it would be all right. That's how you basically calculate that. That's how you count pips. SPX 500 is also indice. The pip is technically 1 decimal over. I'm sorry, it's actually right here. See how the price changes? So for SPX 500, the pip is the first digit on the left of the decimal, and the pip bet is the first digit on the right. So if I wanted to catch 20 pips, and so the price say is 3805.00. Okay. If I wanted to catch 20 pips going up. Then the price would be 38.25. Sorry. 38.25.00. 20 pips and buy. All right. Now, if I wanted to catch 200 pips in a sell, it would be 3605.00. 200 pips and a sell. All right. So once you pick your pairs, figure out where the pip is. All right. And then study the pair, figure out when it's the highest volatility, which means that when is price moving the most and when is the spread the tightest. All right. And so typically, like, for example, since SPX USD is both the New York Stock Exchange top 500 companies and the US dollar, we typically want to trade this particular indice, this pair, during the New York session. When it comes to AUD USD, because it has both a Sydney pair and a New York pair, you could trade it during the Sydney session or you could trade it during the New York session. When it comes to gold, because we have this major USD pair, you typically want to trade it when the New York market is open. And so on. If you pull in your USD, this pair is typically volatile during the crossover of the London and the New York session. All right, because the euro is popular during the European session, aka the London session, and during the New York session. So that during that crossover is typically when you want to start trading with this pair. That's when the spread is going to be the tightest. And so it's important for you to realize when the spread starts to expand, because it's going to be really hard. It's going to become harder for you to make profit. So say this is where the ask and mid price, they're this far apart during the London and New York session crossover, they're this tight. But when you get closer to the, say when the London session closes, the spread then becomes that wide. All right, which means that current price would then move somewhere in between here. And now instead of having 11.4 spread, we now have a 26.5. So it's essentially double. That can happen. And you typically, any pairs that you trade, typically during the New York session, for example, they start to widen around 4:30 p.m. Eastern Standard Time. All right. So be conscious as well when the spread starts to widen, because if you were to put in a buy, you would have to, you're buying it at here, and you would have to wait for, I'm sorry, you're buying it here, but price is actually here when you buy it. You would have to wait for it to get up here for you to actually be in profit. Otherwise, as long as price is below this particular line, you're going to be in deficit. You're not going to be in profit. If you're putting in the sell, you're selling it at this price. Current price is here, but you're selling it here, which means that as long as price is above this particular line, you're not going to be in profit. You have to wait for price. So that's why making sure the spread is tight, making sure they're as close together as possible when you enter your trade is still important. Okay. And the difference between these costs is the cost of the trade. Some brokers will charge you for it, others won't. It just depends on the brokers to do your research. Okay. And then I believe that is it for this particular lesson. If you guys have any questions, if you need a mentoring session, absolutely reach out to your mentors for a further breakdown. If you have any other questions, reach out to people, reach out in the Forex chat group. Like I said, note takers are money makers. And don't worry if this isn't clicking right away. It took me essentially going through basics, open up a demo account for some of these things start to click. So if you're lost, it is completely okay. It's like learning a second language, really. And so don't be discouraged. Just take down your notes, and I promise you, if you stick with it at some point in time, this will all start to click, and then it'll just be second nature to you. All right. So you guys have a good night.